Welcome back to another explainer. Today, we're diving into the story of a real heavyweight in the financial software world, BlackLine. They just posted their Q1 2026 earnings. And look, at first glance, the numbers are fantastic. But if you scratch just beneath the surface, there's this really fascinating strategic transition happening. BlackLine is basically pivoting its entire business model while trying to fend off this new wave of hyper-specialized AI-native competitors. It's your classic battle of incumbent power versus agile innovation, and we're going to break the whole thing down for you today. Right off the bat, we've got to look at this number, 9.7%. That is BlackLine's revenue growth for the first quarter of 2026. Now, context is everything here, right? Because a year prior, BlackLine had bottomed out at around 6% growth. So seeing them bounce back toward double digits, that's a massive signal that their recent strategic shifts, specifically pushing for these larger comprehensive platform deals, are really starting to pay off. You can really feel that energy inside the company right now, too. CEO Owen Ryan actually highlighted this exact momentum in the earnings release. He specifically called out their platform strategy right alongside that accelerating revenue. You see, this isn't just about selling single software licenses anymore. It's about embedding an entire suite of tools directly into the office of the CFO. They're feeling incredibly bullish about where they stand. So here's our roadmap for this explainer. We'll start with the earnings snapshot, then dig beneath those numbers, map out the competitive landscape, check out BlackLine's AI defense strategy, and wrap up with the future outlook. Let's jump right in. Starting off with Part 1, the Q1 2026 earnings snapshot and the strengths of a titan. Pulling back the curtain on the actual SEC filings, total revenues hit that $183.15 million mark. But honestly, you've got to look closer at their profitability. While their GAAP operating margin was 3.4%, their non-GAAP net income was a massive $39.6 million. I mean, they are generating some serious cash here, with the free cash flow margin jumping up to nearly 20%. Long story short, BlackLine absolutely crushed Wall Street's expectations. That non-GAAP earnings per share of 56 cents, that was a 24.1% beat. But honestly, the most vital metric here is probably the remaining performance obligation, which is sitting at $1.1 billion, up almost 18%. Now, why does that matter to us? Because that $1.1 billion is essentially a massive locked-in backlog of committed revenue. It's a financial fortress. Because of that security, management actually raised their full-year revenue guidance, and the stock traded up right after the results. But, a top-level beat never tells the whole story. Let's move to Section 2, beneath the headline numbers and their upmarket pivot. Okay, here is where things get super interesting. We just talked about revenue climbing, right? Yet, take a look at this. Total customer count actually dropped from 4,394 in the previous quarter down to 4,301 in Q1. So, how on earth does a software company grow revenue while actively shedding clients? Well, it comes down to a very intentional strategic shift. BlackLine is laser-focused on enterprise and mega-enterprise customers now. They are effectively letting the smaller fish swim away so they can focus entirely on landing massive six-figure whales. By successfully pushing clients toward comprehensive platform pricing, which now makes up 13% of their eligible annual recurring revenue, they're basically sacrificing sheer volume for high-value quality. But here's the catch. Anytime a massive incumbent vacates the lower end of the market to go whale hunting, they leave the door wide open. That brings us to Section 3, the competitive landscape and the agile challengers entering the chat. And that brings us straight to challengers like FloQast. As BlackLine moves up market, FloQast is aggressively targeting those mid-market controllers. Just look at the stark contrast here. A BlackLine deployment can be a massive undertaking, taking up to 6 months and costing over $340,000 a year. FloQast, they deploy almost 3 times faster, literally in just weeks, for a fraction of the cost. If you're a mid-sized team that just needs close management without all that massive enterprise complexity, FloQast is a really attractive, cheaper alternative. But the threats aren't only in the mid-market. Look at the accounts receivable, or AR department. Yes, BlackLine has AR modules, but at its core, it's a financial close platform first. Enter Transformance. They are an AI-native execution layer built specifically for AR. While BlackLine relies heavily on structured data, Transformance is using vision language models and persistent AI agents to autonomously handle messy, unstructured stuff like remittance advice. Their pitch is simple. If your main headache is AR, why buy a massive closed platform to fix it? And honestly, the broader landscape is equally fragmented with these highly specialized tools. Trintech Cadency is fighting BlackLine directly for Fortune 1000 reconciliation. OneStream is unifying consolidation for global enterprises. Workiva absolutely dominates SEC and ESG reporting. And Vena? They're targeting teams that just want to stay native to Excel. BlackLine is literally fighting a multi-front war against best-of-breed specialists who are just chipping away at different parts of the CFO's office. So, how exactly does an incumbent defend its moat against a swarm of AI-native startups? Let's explore Section 4, BlackLine's AI defense strategy, which they're calling the Verity era. Because BlackLine is definitely not sitting still. They recently unveiled a framework they call Agentic Financial Operations. And look, this isn't just some marketing buzzword. It's a direct response to CFOs who desperately want the efficiency of AI, but are frankly terrified of the risk. BlackLine is pitching a new operating model focused entirely on trust, auditability, and the governance of AI in finance. And the engine behind this model is Verity AI, which is deeply embedded into their Studio 360 platform. They are positioning themselves to be the CFO's essential governance layer. The argument is basically, sure, you can use scrappy AI startups for individual tasks, but for enterprise-grade security, solid audit trails, and platform-wide intelligence, you need BlackLine. They're so serious about this, they even opened a brand new AI innovation hub in New York City to speed up development. But guys, transitioning a massive legacy software platform to an AI-native future isn't cheap, and it certainly isn't easy. It's creating some real internal pressures. BlackLine needs heavy R&D spending to actually commercialize these AI tools. Plus, they're doing all this right as their visionary founder, Therese Tucker, is stepping down and retiring. Add to that the slower overall customer growth and the relentless competition we just looked at, and you've got some very real strategic risks that the market is watching closely. Which brings us to our final section, our summary and future outlook. The ultimate question here, will BlackLine's moat hold? You really cannot overstate the urgency of this transition. Just look at this data from Gartner. By 2027, 62% of all cloud ERP spending is going to go toward AI-enabled solutions. That's up from just 14% in 2024. The shift to AI in finance is absolutely no longer a luxury, it is a baseline necessity. The platforms that win are going to be the ones that actually execute tasks, not just show you a pretty dashboard. BlackLine knows perfectly well that their survival depends on capturing that AI spend. But let's ground ourselves back in reality for a second. Yes, the challengers are loud and they're nimble, but BlackLine's latest financials prove they are still a heavyweight champion. With almost 10% revenue growth, expanding margins, and that massive $1.1 billion in committed backlog, they've got the capital, the embedded customer base, and the deep resources needed to fund this AI defense. They are already deeply entrenched in the daily operations of thousands of mega enterprises around the world. So I'm going to leave you with this to consider. As BlackLine continues this pivot up market, shedding smaller customers to go all in on massive platform-wide AI governance, will their sheer scale and trusted reputation be enough to fend off these hyper-specialized, nimble newcomers eating away at the edges? It is going to be incredibly fascinating to watch this space evolve over the next few quarters. Thank you so much for joining me for this explainer, and keep learning.